IDGT, potentially defective grantor trust, is a trust that's outside of your estate for gift and estate tax purposes, but it's disregarded like kind of like a single member LLC for income tax purposes. And so it's probably the most common estate tax planning vehicle, super ubiquitous. So typically people will set them up for the benefit of their children or maybe grandchildren.
What's this common scenario of like who's the parent or the grantor? Like what is their situation if they're choosing to set up an IDGT typically?
Yeah, so it just makes sense for a lot of people, just because they're so powerful for estate tax savings. But in general, like the most obvious candidates would be anyone who's significantly over the estate tax exemption amount or expects to be. So even somebody with $10 million now, if they're youngish or middle-aged, they'll be way over the exemption amount by the time they die. So it would make sense for them. It makes sense for people even with lower levels of wealth who expect to be close to or over the exemption amount if they live in lower tax states. If someone's sort of close to the exemption amount and lives in a higher tax state, we might recommend number 3 on this slide, which is the non-grantor trust, which is a type of trust that's a separate taxpayer for income tax purposes and estate gift tax purposes. And so the reason these are really powerful is they can save state income tax as well as state tax. And so if you're in New York or California, you can set one up in South Dakota, for example, which doesn't have an income tax. And the trust will not only grow outside of your state for estate tax purposes, but it also won't generate any state income tax liability.
And just because I know this is where we're not going to go too deep in this, and we know these things are confusing, which is why we're happy to chat one-on-one. But just to kind of going back to the IDGT, the IDGT again, core use cases, you are or expect to be significantly over the state exemption. And Peter mentioned this of it can sound confusing of it's outside your estate for estate taxes, but inside your estate for tax purposes. The real kind of impact of this is you can essentially pay the taxes of the trust without it counting as a gift to the trust. And that may sound inconsequential, but it practically means is over the long term, you're able to, for folks who are over the state exemption or significantly over, they can actually get most of their assets outside of their estate because of that feature. And this is where it may not seem like much, but it is a really, really powerful structure and why it is kind of the go-to, as Peter was saying, the most common. So it's if you're over or expect to be over, this is a great way to move these assets out of your estate and ensure that you essentially completely avoid estate taxes. And obviously, avoiding a 40% plus tax is really significant to maximizing what you can pass on to future generations. And I'll call out just one other quick benefit while we're talking about it is a lot of people are also worried about, hey, what if I gift too much to this trust and I can't access it? One big benefit of IDGTs is you can give yourself loans. You do have to pay interest on it, but it means that you do have access to liquidity. Am I kind of missing anything with those two kind of key benefits, Peter?
Yeah, and the other thing on loans is the loan interest isn't taxable when you borrow or lend to an IDGT because it's disregarded for income tax purposes. So it's like this is if you're loaning money to yourself. So there's no tax consequences of the loan.
Yeah. Now going back to Peter started talking about this with non-grantor trusts. Non-grantor trusts are their own tax entity, and so part of this is you can't pay the taxes for it, that benefit that you get from an IDGT, but the most common place to cite these are no tax states like South Dakota. And really the arbitrage is, let's say you're a Californian. I used to live in California, which is part of how kind of what drove me down this path is you pay really high taxes. You can be paying, most of the folks who are looking at this, maybe paying 13% for their capital gains. And hey, if you lose 13 cents out of every dollar, that's a significant chunk of change. But if the trust owns it and it's based in South Dakota, you can avoid that 13% tax. And so it is, you could move the assets outside of your state and lower the tax rate that you pay when you sell those assets. Is that right, Peter? Or am I missing anything?
Yeah. It's essentially the trust is treated as a resident of the low tax state or the no tax state, and so it's taxed the same way. Somebody who lives in South Dakota would be taxed if they made an investment. So.
Yeah. And another common use case doesn't come up as often for folks, but the non-grantor trusts are often also used for QSBS stacking because they're their own individual. Folks who have more than $10 million in asset may set up a non-grantor trust, transfer their eligible QSBS shares to get a second $10 million exemption. And by the way, Stefan, we see your question. We'll kind of get to that. One thing I want to ask you, Peter, is we said kind of IDGTs are one of the most common solutions for folks who are worried about the estate tax. Who doesn't it make sense for?
So there's no one for whom I would. So anyone who's going to be subject to estate tax or thinks that their estate's going to be subject to estate tax, I think it makes sense for anyone to do an IDGT if they're in that situation. There's no one for whom it makes no sense. I think that a lot of times people who live in high tax states and are close to the exemption amount, not like billionaires, are attracted to the idea of saving state income tax. And so they like the idea of saving lots of state income tax, even if it means a little bit less estate tax efficiency. But IDGTs arguably makes sense for just about anyone who has a significant estate. Yeah.
Essentially, if you're over or expect to be significantly over the state exemption, IDGTs are likely part of your solution. If you're close to the exemption amount and or in a high tax state, they may be part, but they'll be probably a lower allocation of your assets or not part of your plan. Is that fair to say?
Yeah.
And so I guess kind of taking that question, who doesn't a non-grantor trust make sense for?
Yeah, so a non-grantor trust doesn't really make a ton of sense for people in low tax states like Texas, because one of the big benefits of a non-grantor trust is the state tax savings. The one reason people sometimes set up, well, aside from what Monty was mentioning, which is non-grantor trusts can get their own QSBS exemptions, $10 million QSBS exemptions for people with QSBS eligible stock. But aside from that sort of narrow situation, it doesn't make a ton of sense for people in low tax states to set them up. There's a lot more flexibility with an IDGT, and the estate tax savings from an IDGT are more powerful than the estate tax savings from a non-grantor trust.
Got it. Now, the third kind of structure we talked about is kind of in ILIT. Maybe let's start with what does it stand for, and what's the common use case for using one?
Yeah, so ILIT stands for irrevocable life insurance trust. It's a type of trust. It's very similar to the IDGT, but it's a type of trust that's specifically designed to hold life insurance. And so typically what happens is people will gift cash to the ILIT, and then the ILIT will go out and acquire a life insurance policy on the life of the grantor or donor. And then when the donor dies, trusts are created for the benefit of the donor's children or grandchildren, whatever they want to do. And the proceeds, the insurance proceeds, are entirely outside of the donor's estate. So it's a big estate tax savings.
That makes sense there. There's a question from Stefan here, putting this up on screen. Which trust option offers the most asset protection while the client is alive? Is there a clean way to answer that, or maybe talk about the other factors that can kind of impact this, like where the trust is located, when you fund it?
Yeah, so that's a good question, and one of the big benefits of sort of estate tax planning is you get a lot of credit protection from gifting assets into trust. And so in general, all of the trusts that we're talking about today create a lot of credit protection for both the grantor and the beneficiary. And the certain types of trusts
Hey,
create
hey,
less.
before we go farther, what does creditor protection mean?
Yeah, so it's it's protection from all types of creditors. So creditors could be the neighbor who falls walking on your driveway or something and sues you. Could be some business litigation issue. Could be divorcing spouse who's going after uh, the their ex-spouse's assets. Um, so any person who claims some share to your assets for whatever reason.
That that makes sense there.
Yeah.
So that's kind of
the one other thing I'd add to Stefan's question is, so all of these trusts, non-grantor trusts, IDGTs, SLATs, ILITs, provide a lot of asset protection. The one factor that matters is the state that the trust is created in. So some states have a little bit stronger asset protection laws than other states. So, for example, South Dakota, Nevada both have very strong asset protection laws, and it's very, very hard for creditors to go after either the beneficiaries or the grantor of a trust created in one of those states and get to the trust assets. But even if you set up a trust in California, an IDGT based in California, you get a lot of creditor protection relative to almost any other structure.